Hello everyone, welcome to this session. The previous sessions we have seen the accounting life cycle. Now in this session we will apply the accounting life cycle to a real life scenario. So we will see how to create a journal entry, how to record a transaction, how to post into a ledger and how to create a trial balance. So that we will see with an example. So the first activity over there is a journal. So basically what we are actually doing is we are actually recording this transaction by using journal entries. So basically how the journal entry is actually prepared is you need to see what is the account that getting affected. So what is the debit effect and what is the credit effect. Then you need to understand whether the account is a personal account or a real account or a nominal account. Then apply this debit and credit concept to the accounts and you need to prepare the transactions. So let's give an example. Let's say I'll take an example of ABC company raised a capital of $50,000. Okay, $50,000 by cash. So let's have a look at the example of this example. So ABC company raised a capital of $5,000 by cash. Now first step in the journal is you need to understand what are the two accounts which gets involved and what kind of impact they have. Now let's look at what are the two accounts which is getting impacted here. So when a company raises capital by cash, so what happens, right? The cash comes inside the organization, means the company gets the cash. So that is one account. So what is happening when they raise the cash, when the capital is raised, the cash is coming in, the cash balance is increasing. So the cash balance is increasing. One. Then when the company raises cash, they are raising by, it is actually done by issue, means by raising a capital, it's done by issuing a capital or by issuing shares. So in this one, the capital also is increasing. Now if you see what kind of asset or what type of account this cash and capital is. Now there are three accounts: personal account, real account and nominal account. Both cash and capital are real account. Cash is a real account and capital is also real account. A cash is a asset for the company and a capital which is raised becomes a liability because that need to be given back. Now applying this rule, apply the rule of a real account. So what real account says that debit what comes in. Debit what comes in, cash is coming in. So what I will do is I will say cash account debit will say $5,000 and the capital. So here actually what happens is the cash is actually comes in through way of capital. So the capital we will actually put the capital account credit. Now if you see here, the capital is actually a liability and the liability is actually increasing. So the entry for this one will be cash account debit and capital account credit of $5,000. So the first step in the accounting cycle is preparation, means recording this transaction. The transaction is recorded by posting a journal entry. Now the journal entry can be posted by using a traditional approach of following three golden rules or following the modern approach where you apply the rule of asset, liability, capital, revenue or expenses rule and you pass the journal entry. So that is the first step in the accounting cycle is passing the journal entry. Now once you pass, you need to create a ledger and post these balances to the ledger. Now the ledger, once the journal entries are posted to the ledgers have to be balanced out. Now let's continue with that example and understand how the ledgers are created. Now when you look at this journal entry, there are two accounts getting involved here. One is a cash account, other one is a capital account. So let's create two ledgers. The first ledger is a cash ledger. The first ledger is a cash ledger and another ledger is capital ledger. So we will create, because there are two accounts are involved in the journal entry. One is a cash account, other one is a capital account. So you need to prepare two ledgers here. Now you are prepared two ledgers. In this journal entry, if you look at, right, cash is having a debit balance. That means in the ledger, there are two sides are there. One is a debit, another one is a credit. So there are two ledgers, two sides will be there. One is a debit side, another one is a credit side. Okay. So one, there is a debit side and there is a credit side. Now let's see how to post, okay, how to post the journal entries to the ledgers. Now let's first, I'll talking about cash account. In the cash account, what you see is, you see the cash account, the entries on the debit side. So when you are posting to the ledger, the entry should come on the debit side. So how do you name? You just put it in the debit side, but you mention the name of a other account. Let's say I say capital and I'll say debit of $5,000. And in the capital ledger, it's on the credit side. So put on the credit side, but what you do is you just put the name as a cash. So this is how, you know, what happens is the ledgers are posted, the entries are posted to the ledgers. So here I have the capital of $5,000 and here I have a cash of $5,000. So this is how the entries need to be posted. Now this is an example of how the entries should be posted to the ledgers. First step. So step one, post journal entries to the ledger. Then after posting, there is a step 2. In step 2, you need to balance the ledger. You need to balance the ledger. The ledger have to be balanced. Now, why do you need ledger? Why do you need ledger need to be balanced is now? Now, if you look at, right, in the cash ledger, the debit side is 5,000. However, the credit side balance is nil. So here there is as of now the ledger is imbalanced. They are not balanced. So what you do is, how do you balance the ledger? Now whichever total is higher, apply on both the sides. Now in this example, the debit side total was high. So I applied the debit side total to the credit side. Now if you see, one side of the ledger is not balancing, okay, means it is less. So which side is less now? We have a debit balance, but the credit side is lesser. So what I say is, I say balance brought down, and I say is 5,000. Now your ledger on the both the side is balancing. It's on the balancing side, right? So this is what we call as the balancing the ledger. Now step 3, you have post the balance to the trial balance. Now the trial balance need to be posted. Now in accounting, you cannot use this. What happens is, the balance which is brought down, you cannot use for that. That cannot be used. That should not be posted into trial balance. Instead, you need to bring the balance to the other side. Now let's say, for example, what I'll do is, in this one, the cash ledger, the balance, I'll say this as a balance brought down. Now balance brought down, I say it is 5,000. So this is the balance which need to be taken to the trial balance. So in this side, the cash ledger has 5,000 trial balance. Similarly, the same concept need to be applied for cash ledger. Now if you look at cash ledger, right, the cash ledger has a high on the ledger. It's on the credit side, it is as a total is high. So what I'm doing is, I'm applying this credit side total to the debit side also. Now if you look at capital ledger, which side is not balanced? The debit side is not balanced. So what I say is, I say balance brought down 5,000. Now this balance have to be moved to the opposite side to shift to the trial balance. Now if you move it to the other side, it will be like balance. Sorry. When we are moving, we will mention this as a balance carried down. We will mention as a balance carried down. Now we have posted the entries to the ledger and we have balanced it. Okay. Now the third, this is the second step in the accounting life cycle. So once your journal entry is done, then you need to move the balances to the ledgers. Then the ledger have to be balanced it out. Okay, objectives, this is our ledger format. Okay, then it is we spoke about balancing and posting it. Then we need to prepare the trial balance. To prepare the trial balance, the balances have to be moved to the trial balance. So we have, let's say we prepare a trial balance here. We prepare a trial balance. Let's say we prepare a trial balance, and the trial balance will also have two sides. It will have a debit side and it will have a credit side. Now what I will do is I will move the ledger balances to the trial balance. Now what is the first one we have? We have a cash. Now look at cash is having a debit balance or a credit balance. The cash is having a debit balance. So I say this is cash 5,000 debit balance. Then second concept we have capital. So capital is debit balance or credit balance. We have a credit balance. Now I'll say capital is 5,000. Now if we total the trial balance, right? The total of debit side, you just total the trial balance on the both the sides. So in this we have only one entry. The total of debit side is 5,000 and the total of credit side is 5,000. So if you look at here, the trial balance is actually matching on both the sides. So this is the third step in the accounting life cycle. So this is, and you need to ensure that, as I mentioned previously before, the trial balance total have to match. So this is the process you need to follow for preparing a journal entry or recording for the purpose of recording the transaction. Then you need to post it to the ledger. Then the ledger have to be balanced. After balancing the ledger, the trial balance need to be moved. The ledger balance need to be moved to the trial balance. So this is the process. This is the process you need to follow while you are actually recording the transactions. Okay, thanks for your time.